All right, so we've gone through the plumbing, through shadow banking, through central banks, to surface expression of these things, right? And we argued that equity and the VIX and commodities and forex and the real economy, all of these things that we're observing, they're actually all entirely just derivatives of some underlying financial plumbing and of sovereign collateral markets. Kind of a big claim to make, okay? We've journeyed through all 6 layers of those traditional financial systems. It's more modern global system, from all of those things. But this brings us to the final kind of idea, which is that there is a frontier of alternate systems. This is the world of stable coins, crypto, and decentralized finance, often written like this. These systems are often seen as a radical break from the past. But if you were to approach this from first principles, it reveals a different story. So this leads to, one could postulate, this would be a new law, okay, of finance. From the impact, of crypto, of the cryptocurrency markets. And this new law of finance, we could say, is that new financial technologies do not escape the logic of hierarchy. We can't reinvent the system that we have already made, but inherently they're going to replicate. They replicate it, okay? So these frontier systems, these stablecoins, crypto, decentralized finance, all of these things, they're creating new forms of something. Remember from our very first episode, inside money. We're creating new forms of inside money, and we're calling them now tokens. Okay? And these are tokens, and their value is derived. Okay? It's derived by being backed. They're being backed by collateral drawn from the traditional global system itself. Okay, so to understand this, we can have currently this is a very hot topic in the news, but stable coins. Such as, USDC or Tether, all of these guys, right? Stable coins, these are like, synthetic euro dollars. Okay? So as Peter Merling put it, okay? Oh, sorry, Perry Merling. Okay, in his book, I think it's Lombard Street, really good book. But towards the end, he argued, right, that a stable coin is best understood as an upgrade, right, a modern euro dollar. And so this is a privately issued dollar liability that exists outside the direct perimeter of the Fed. So it's stability, right? So basically what this means is that the stability of stable coins depends entirely on the assets that back it. So to prove this, we want to look at its balance sheet. So let's say we have a stablecoin issuer. Okay. And its assets are US treasuries. Okay, so we've got that sovereign collateral. Okay. And this is, guess what this is? This is L1, right? This was our first layer, right? What they also might have is cash deposits. What layer is that? That is layer 2. And they also might have repurchases. Okay? We discussed that also in layer 2 or episode 3. Okay? So, okay. What about the liabilities? Well, the liabilities are actually going to be stable coin tokens. Okay? And these stablecoin tokens are in circulation. Does that make sense? So look at the asset side, right? Look at this asset side. The foundation here of this new decentralized, right? This quotation mark decentralized dollar is, pristine collateral from the very traditional hierarchy we've spent the entire series exploring. And a stable coin is a promise to pay a dollar backed by claims on the old system. Okay? So the stablecoin stability is entirely contingent on the liquidity of its backing assets. Okay? Hopefully that makes a little bit of sense. The second key mechanism recreates the function of the repo market on chain. Okay? We'd say it's a repo market on chain. Okay? What is that? What the heck does that mean? Okay? Well, we have this thing called DeFi, decentralized finance lending. And it happens to be an algorithmic repurchase. Okay? Protocols. Okay, so we have something in decentralized finance that we call a protocol. Okay? Something like Aave or Compound. These are two different protocols. Aave or Compound. These are essentially automated repo markets. Does that make sense? They use smart contracts, okay? Call something a smart contract. Okay? To perform, the point of a smart contract is to perform collateralized lending. It's a new type of collateralized lending, right? It's a new type of repurchasing market, okay? And but here's the thing. Here's the crazy part about it. There is no dealer. There doesn't exist a dealer in this sense, right? Because it's an algorithm. It's a bot. Okay? So user deposits. Let's say, okay, let's walk through this, right? This is how crypto works. Okay? A user deposit. Okay, user deposits. Let's say Ethereum collateral. Okay. Into a smart contract. Back with our caveman talk. Okay. User deposits Ethereum collateral into smart contract, okay? Then the smart contracts allow them to borrow, right? We borrow stablecoins. Okay? And typically, remember, the balance sheet tells us, right? The balance sheet tells us that it's contingent upon its sovereign collateral that it has and its cash deposits and its repurchases. Okay, so we borrow stable coins, remember, denominated in USD. Okay, and then rules are code. Okay, so the rules for this market are code, and we'd say the haircut. Okay, this traditional idea of a haircut. What is a haircut? It is LTV. Okay? And automated liquidation. Does that make sense? So instead of a dealer setting a haircut, right? There's no dealer doesn't have to set a haircut. The protocol is pre-programmed a loan to value ratio. That's what this is, the LTV. So what that means is for every $100 of Ethereum collateral, you might be able to borrow about $70 of stable coins. Okay. See what I'm saying? So if the value of your collateral falls below a certain threshold, the smart contract doesn't call you for margin. It'll automatically sell your collateral to repay the loan. So the financial function, right? The financial function of this, depositing of Ethereum collateral into a smart contract to borrow stable coins, it is identical to a traditional repurchasing market. It's actually collateral transformation. Okay? We've transformed collateral. It's just enforced by algorithms instead of lawyers. Okay? So this leads to a really fascinating dynamic of this new kind of frontier-like layer, okay? So rather than, escaping the old system, right? The frontier now is feeding back into it and actually strengthening the traditional global system. So if we want to close this loop, right? The frontier, I before E, damn. The frontier feeds the base. Okay? Think about it. What's the biggest source of demand for the assets on a stable coin's balance sheet? Okay? Well, let's think through it, okay? Stable coin. All right? Well, the most fundamental asset of the entire pyramid is, the pristine, sovereign collateral from layer 1. Okay, so stablecoin issuers are now among, the largest buyers of short-term U.S. Treasury bills in the world. The frontier is not a separate universe, okay? And of course, remember, the liability here in this market is the tokens. The stablecoin tokens, right? The loans, right? This is something that can be loaned. It's I'm sorry, yeah, sorry, something that can be borrowed. That's right. So and then the smart contracts, gives us the repo market, but the dealer just kind of does this for us. Okay. So the tokens are on the liability side. Okay. So the frontier is not. Remember, it's not a separate universe. It's a new appendage, right? We're appending this to the traditional hierarchy that closes the systematic loop, reinforcing the primacy of the base layer. Okay, so remember we have L0, L1, right? L0, what is L0? L0 is the outside and inside money concepts, right? And the balance sheet definitions. L1, what does that tell us? That tells us that we are replacing outside money with sovereign collateral. Okay. And then L2 tells us about the repurchasing agreement markets. Okay. And then L3 tells us about shadow banking. Okay. The role of shadow banking, foreign exchange swaps, the role that they play, as well as taming the market, making sure that it's regulated in such a way. And then, of course, L4 through L5 and L6. All of these things are kind of more surface level things. But, of course, this is the credit market. And then this would be the commodities and foreign exchange. And then, of course, all of those things then give us our derivatives, okay? And equity is a derivative, and volatility is a derivative. These are all systematic things. And then, of course, you could argue, yes, there's like options market and stuff, but that's all included with equity, okay? Those are all the same thing. Options are just leveraged equity, okay? And just tell you a little bit more about how equity is moving around and stuff. But there's nothing really... These are all symptoms of what's happening underneath, okay, in the global econometric system. Now, the last thing, of course, would be tying the loop, with this higher kind of, this frontier, right? It's supposed to be a frontier, but we're actually closing this journey out, because what this shows is that this so-called decentralized finance, right? This fancy way of talking about it, or DeFi, trilemma of trying to achieve, the trilemma is trying to achieve decentralization, scalability, and also security, right? Encryption, decrypto. We want security of these things. We want all of these things all at once. That's basically what the DeFi trilemma is. But it's just a technological rebranding of the timeless financial trilemma, right? Okay? And so this is more of a timeless trilemma, okay? This has nothing to do with DeFi. Timeless trilemma. Okay? And so the timeless trilemma really just tells us that there's a struggle to provide safety, liquidity, and yield simultaneously, right? We want to find we want to max this guy out, right? We want to max out all of these numbers. That's the trilemma. That's the true trilemma, okay? And you can usually only just pick two of them. So, what that basically means is that, if we have safety, it basically makes we have safety, liquidity, and yield, okay? Fully decentralized systems are inherently brittle, right? Because they lack the capacity for discretionary intervention, okay? That dealer of last resort, right? The dealer of last resort in L3. Okay, if you remember that, the shadow banking kind of regulating, what's happening, requiring certain, policies and all of these things to make sure that banks don't get completely destroyed, right? The Bank of International Settlements, the Fed, they provide stuff in a crisis, right? They can create money out of thin air just in case, everything gets destroyed. But the elasticity that's provided in this, there's no backstop in crypto. So if crypto goes down one day and it has its own funding crisis, it's just gonna go to zero, man. Okay, so to summarize our final layer here, is that new systems, whatever we're trying to do, it inherently, really, it's just replicating the logic of the old hierarchy. Okay, so it's more important just to study the old hierarchy. Okay, but it's interesting to see things branded in a different way, or try to see certain things with crypto. The advantages that it has. Having an automated market maker, an automated smart contract with fractions of liquidity that it's fixed at, or a certain way of determining that with protocols. These protocols over here, these are interesting ideas. These are novel progressions of financial systems, but the mechanisms really are synthetic euro dollars or stable coins and an algorithmic repo, which is decentralized finance lending. Okay, so really, when we interconnect the logic, right, it's that this guy here, 7, right, this frontier, it closes the loop, right? It creates new demand. So this is really what's cool about this. It creates new demand for collateral. Okay? And sorry, it shouldn't be this one. It should be more so this one. This is where sovereign collateral is, right? We replaced our idea of trust with collateral, okay, from the purist perspective, okay? And so, the new demand for this, right, the frontier actually strengthens the global kind of system as we know it. From this, then again, this is a theory, right? We don't know the consequences of this experiment so far, but in terms of how it looks logically, right, the future of these systems we'll likely see them either fail in some major liquidity crisis, right, with these algorithms that are automated in such a way, or we'll progressively centralize and replicate the dealer-based kind of publicly backstop structures they originally sought to replace. So this hierarchy, it seems though, this hierarchy that we've discussed this entire time, if you took the time to walk through all of my videos, the way it's framed, the way that decentralized finance is framed, it seems like this hierarchy in and of itself is inescapable, right? The development, from this point on, in human history, for the beginning and kind of the modern day uses of money and fast liquid transactions and digitization of money, all of these things, it seems like this hierarchy is inescapable, even from decentralized finance, right? So thank you guys for watching. I hope you enjoyed this. I did kind of yap a little bit more on this last one, but I think this is probably really where it all comes together, is right at the frontier. So please leave a like, comment, subscribe. Let me know if you enjoyed this, if you want to see anything else. But yeah, that's it.